Then, for the first time in more than a decade, investors looking for income have lots of good options. We'll share the best opportunities. We'll tell you what to consider. And later, it's the same medicine, but the version for humans costs as much as 37 times more than the one for Fido. We'll explain. But we begin, as always, with three things investors ought to be thinking about right now. Stocks ended the week higher amid renewed confidence in a soft landing for the economy. Bad weather and wildfire haze causing trouble for air travelers heading into the holiday weekend, but airline stocks are hot right now. Then, employees working from home want to keep it that way. Concerns about office vacancies have created value for REITs in certain markets. On the Barron's Roundtable, my colleagues Ben Levison, Carlton English, and Andrew Berry. So, Ben, explain this to me. The Fed has hiked from 0 to 5%, and yet the job market is strong. GDP is up. The S&P 500 is up 16% only halfway through the year. What's going on?
Well, I mean, I think we had our bear market last year in anticipation of all these rate hikes, and now the market's looking and saying, okay, the Fed is almost done, and we're going to go higher. And as you said, 16% for the S&P 500. That's the best since 2019, which, okay, that's not so long ago. Look at the NASDAQ. It's up 32% so far this year. That's its best for 6 months since 1983. And basically, the market came into this year and it said, hey, we can see the Fed stopping their rate cuts by the end of the year. The economy seems to be holding up. The job market is still strong. We have no reason to drop here. And even something like the student loan decision by the Supreme Court doesn't look like it's going to slow down the economy right now.
Okay, so you mentioned that great run by the NASDAQ. So this is interesting. I saw this stat that the 5 top stocks in the Spider Technology ETF are up 73% on average year to date. So do you keep on chasing those guys higher, or in the second half, do you look to some of those more boring stocks that have started to pick up but have not done nearly as well?
Well, I think you want a mix of both, actually. I looked at the stocks that doubled over the last 5 years in the first 6 months of the year, and oftentimes they do pretty well. They mostly don't double again, though it happens sometimes, but they can continue to do okay. But I think now we're at a point where people are starting to come around to the idea that we're not going to have a recession. That's going to be good for things like banks, for industrials, for oil stocks. And these are sectors that kind of lagged earlier this year, and so they should be able to do pretty well.
We always say that the next payroll number is going to be really important. Maybe this time we can say not that important?
We'll see. I mean, I think that people are still waiting to see if the job market is going to weaken, and that would be the thing that gets them to worry about recession. We haven't really seen it yet. And so if we did get a surprise jump in layoffs, if we did get a surprise increase in the unemployment rate, a real meaningful one, then you might have people reconsider. But until then, I think the market is just going to say, hey, we're in an okay spot.
And good news is good news, which is sometimes unusual.
Very.
Andrew, really tough week for some flyers. I got lucky. I went across country and back with no delays, but flights were canceled. It was awful. And yet through all this, every single seat in my airplane was full, and airline stocks are doing pretty well.
Well, this is a very robust summer for air travel. I mean, you may exceed the 2019 levels, and the airlines are basically doing very well. It should be a very strong summer. And with recession fears easing, the stocks have really been on a tear lately. They're up 30 to 40% literally in the last month alone. And Delta's been a leader in that area. Delta's the industry leader, had a very upbeat analyst or investor day this past week, raised financial guidance, and the stock's now run 48 right now, which is still pretty reasonable at around 8 times earnings.
One thing you've been warning about in the travel industry, though, is those cruise stocks have also had a great run. You say it might be time to stay away.
I'd be cautious on the cruise stocks like Carnival and the others. They're up. Some of them have doubled in price so far this year, but debt levels are up dramatically since pre-COVID. Carnival has over $30 billion in debt, which is 3 times what it did then. So I'd be cautious on them because of interest expense and capital expenditures.
Let's pivot to a different summer tradition, the blockbuster movie. I'm going to go see Mission Impossible week after next. How's that business shaping up this summer?
It looks pretty good. I mean, this weekend we're opening with Indiana Jones, which is starring Harrison Ford, who's 80 years old now. He's kind of the Joe Biden of Hollywood. And we have another older star in Tom Cruise, who's 60, starring in Mission Impossible. Then you have the new live-action Barbie movie opening on the same weekend as the prestige movie this summer, which is Oppenheimer, about the development of the atomic bomb during World War II.
I think very few people in the country will be, do I go to Barbie or do I go to Oppenheimer? I think it's one or the other for most people. Carlton, let's switch over to this interesting economic data. We know that productivity has been flatlining for a while. Is this connected to the stay-at-home trend?
Apparently so. Data from the Bureau of Labor Statistics shows that people who work from home work 2.5 hours fewer per day than their in-office counterparts. Now, this is especially important as managers are trying to get people back into the office, but it's not just managers that want people back in the office. Office building owners would love to get people back in the office because a lot of office REITs have seen their stocks fall by about 50% or more over the last year. And you have office vacancies as high as 25% in cities like Chicago and San Francisco.
So where's the investor opportunity?
Well, if you were at the top of these office REITs, not looking so good, but this actually could be a buying opportunity as long as you're willing to stomach a little bit of volatility and do some sifting and sorting here. One thing, office REITs are looking cheap, trading at about 9 times forward earnings. That's about half what the S&P is trading at. So you look at something like Boston Properties, 91% occupancy rate, you get a good dividend there. Some other places to look would be Cousins Properties and Highwoods Properties, both based in the Sun Belt, which we know saw an influx of people. More people means more workers. And to get good dividend yield.
Other side of the story, residential rents going up. So do investors want to be there?
Again, be careful because while people are moving to the Sun Belt, you are seeing so much building there that rents are going to be a little bit under pressure in those areas. You want to instead look to some of the coastal areas where there's not as much building going on. So you would look at something like an Avalon Bay or an Equity Residential.
And I just got to say, I've been on Zoom calls with you guys at all hours. I know when you're working from home, they're not 2.5 hours shorter days.
Thank you.